Welcome back to another episode of the Wealth Building Strategies podcast. I'm your host, Jeremy Constantino. And today we are finishing up a three-part series entitled, What is a Real Estate Syndication? Today is part 3, Underwriting and Due Diligence. So if you haven't listened to the first two parts of this series, go back and listen to part 1, where we talk about basic structure and overview of what is a real estate syndication. And part 2, we talk about the many benefits of investing into a commercial real estate syndication. So without further ado, part 3, underwriting and due diligence. So what is real estate underwriting? Real estate underwriting is simply the evaluation of a real estate investment. That's it. So when we talk about underwriting and that term, it is simply the evaluating of a real estate investment to see if it is good investment or not. The underwriting process generally involves a very detailed analysis of expected cash flows, the local market, supply and demand, and risks, such as the physical state of the property, environmental risks, zoning, taxes, insurance. So that whole process, the detailed analysis of a real estate investment property or project, is called real estate underwriting. Now, for a real estate syndication where there's active investors and there's passive investors, the active investors, generally called the general partner, the GP, the GPs, the operators, the lead syndicators, the lead sponsors, the active investors, all different terms for generally the same thing. Their process for underwriting investments is extremely rigorous. And I'm actually going through that same process right now on a deal that we're looking to buy and to acquire. We're looking at acquiring a 40,000 square foot office portfolio package deal. And I'm spending about 2-3 weeks looking at all the comparable sales, the comparable leases, the market data, the population growth, the economy. And I have to do that because I am the general partner in this deal. And I need to make sure that this is a solid and safe investment for the passive investors who are looking to partner with us and invest on this deal. They're not going to have the time to do this analysis. Therefore, they have to trust my work as underwriting and analyzing this specific real estate investment deal. And therefore, I, along with my team, spend hundreds of hours analyzing and underwriting many deals across the country throughout the year. That's our job. So, for a passive investor, what should they do? And what type of underwriting should they do? And when they come together to form a real estate syndication. So should they completely trust my work and the work of my team? Or should they do a double dipping and do some quick analysis themselves? So I'll answer that quickly. There's two ways, and there are two ends of the spectrum. The first answer is that a passive investor most definitely can completely trust the underwriting and leave that be to the general partner. I'll say that again. There's many investors out there that don't want to look and analyze at the deal. There's many investors out there that will tell me, say, Jeremy, I trust you. Just send me the deal. And whenever you send me a deal, I will trust that you've done the due diligence and it's a great deal. It's a safe investment. And I'm going to put my money in the hard-earned money that I've earned my entire career. I'm trusting it to you, and you've done your homework. So that's one end of the spectrum. And I've done that many times myself as a limited partner. It's a limited partner, passive investment. I know who the good syndicators are out there in the space. I know them. I trust them. The deal comes through, and within a split second, I say, I'm ready to invest, and I'm ready to sign the subscription document, sign the operating agreement, and send the funds. So that's very common in this industry, that the general partners, the syndicators, have established themselves in the space, and that investors, right when the investment opportunity comes up, boom, they're ready to invest. Regardless of what the deal is, they trust the operator. So that's one end of the spectrum as far as what to do as a passive investor. Now, on the other end of the spectrum is the passive investor doing a lot of the due diligence and a lot of the underwriting themselves. So I've had investors tell me, hey, Jeremy, I have a question about your numbers. I was actually trying to recreate your spreadsheet, your economic analysis, and I had some questions on this, that, and the other. So there's actually investors that go ahead and recreate the Excel spreadsheets and the financial forecasts, and they spend a lot of time analyzing the deals themselves as well. And that's okay. And that is okay in that the investor wants to have a sense of security and wants to start building the trust for the general partner. So this quick little episode is for you out there that are just starting to get into commercial real estate investing, especially as a passive investor. Here's some quick tips for you to do that. And it is okay. And it shouldn't take that long. So I'm going to give you some tips on what to do, on how to underwrite, and to double check the work of a general partner that you're partnering with. Okay. So the first thing when doing your underwriting regarding a property, investment property, or multiple properties, is to look at the location. There's many people out there that say there are 3 rules in real estate, and that the 3 rules are location, location, and location. That's what some people say. So what do we mean by that? The location has to be, this is just the most important aspect of real estate and why it works. What I'm about to say. It has to do with population growth. Population growth is the number one variable in real estate and why real estate is successful. And when you're doing your underwriting, you need to understand population growth for the area, the submarket that you are looking at. So another term here, quickly to sidebar, is submarket. A market is the general market. So Dallas-Fort Worth metro area is the market. Houston is a market. Atlanta, market. Now there are submarkets within those markets. And those submarkets, they have different behaviors as far as, and different, the numbers are different and vary between the different submarkets. And it's important to understand those different submarkets. So if we say Dallas-Fort Worth is growing, and there's population growth, and that's a fact, but there are actually pockets within Dallas in which certain types of real estate, certain asset types of real estate have high vacancies and are not appreciating. For example, we lived in Richardson, Texas, and Richardson, Texas had a very, very high commercial office vacancy. So when you're investing and doing an economic underwriting and analysis, you need to know the vacancy rates in that submarket of where you're at. And you can't assume that it's a similar vacancy rate as, Frisco, where there may be lower vacancy rates. So very important. So going back, this is as a limited partner, the first thing that you need to look at is the location. And those rental rates, if you're renting out, if the property is going to be a buy and hold and renting out, or the comparable sales prices when selling the property. What drives the population growth and what's driving this whole thing is employment growth and job creation and the economy. So it's really important to understand what businesses are moving into that submarket, what new headquarters are starting up. For example, I'm looking into investing into the Fayetteville area in Arkansas. And so this is a new market for me. And so the first thing that I do is I look at the job growth and the creation. And the first thing that I find when doing my underwriting and my research is that Tyson Foods, Walmart, there's a lot of different companies that are moving to the Fayetteville, Arkansas area and setting up and building headquarters there. So what that does is that drives the economy, jobs are created, people move, population goes up, and with population goes up, they need real estate, and that makes what makes the real estate market so good. Okay, first thing, confirm the location, confirm the submarkets, and really make sure that the rental rates and the comps are there. Next, the second thing that a passive investor needs to do is they need to understand the profit and loss. So the property, the real estate investment is simply a business. It is a business with expenses and income coming in and expenses going out. So very normal. Looking at a deal, you have to understand the income coming in, expenses going out, and it's just a gut check. Are the expenses reasonable? Is the income reasonable? And that's going back to the location, the population growth. And the third tip that I have for you is always read through the lines regarding assumptions. So when the general partner says, here are my underwriting assumptions, here's some assumptions I made, you really need to pay attention to those. And those assumptions will make or break a real estate investment deal. Okay. I have three assumptions that you need to pay attention to. The first one is called the stabilized rental rates. And what do I mean by stabilized? So stabilized or pro forma is another word for it. So there's the current rent rates of a building, and that's what is coming in now. But in the future, what are we forecasting, or what's the project forecasting of renting out those units for? And that's called the pro forma in the future, or the stabilized, the pro forma rental rates in the future. What are those assumptions? Are we really going to see a 10% year over year growth on rental rates? Probably not. 5%. I don't know. We have to go back to the location. But big red flags when you're looking at those assumptions. How optimistic are they on those assumptions specifically for rental rates? The next thing you got to look at for assumptions is executing the business plan and the renovations, filling the vacancies. Those are all assumptions. Are we going to be able to raise fill the occupancy from 50% occupied if it's a strip center, a retail strip center, to 50% all the way up to 100%? How realistic is that? If a multifamily unit is at 80%, are we really going to bring it up to 100%? So fill the vacancies. So that's the second assumption to look at. And the most important assumption is the final sale price. And the final sale price is the assumption is, what is the market cap rate in the future going to be? So if the cap rate in the future is lower than what we brought it for, red flag. You usually want to see the cap rate higher in these assumptions in the future. So I'm not going to go into detail on the cap rates, but cap rate in general is the net operating income divided by the sale price. Okay, so buying a property at a 6, 7, 8 cap right now basically means you're making about 7% return on your investment if you buy the property cash, no debt service. But anyway, it's about 6%, 7%. That's just in general. And if you increase the rental rates, increase the vacancy, increase the occupancy, then you are going to increase your sale price. And if you forecast a small and a lower cap rate, then that's just going to make your assumptions go crazy and you're going to have a very high sale price. But anyway, point is, look at the final cap rate and ask questions about the cap rate. It is the single biggest assumption in which real estate investors and syndicators may have a problem assuming, and it changes all their numbers. So that is the most important one, is making sure the assumption on the final cap rate is conservative. Okay, so those were the 3 tips that I have on looking and analyzing the property from a limited partner perspective. And I got one more suggestion for you when doing underwriting. And the underwriting is, and the due diligence is not necessarily on the property, but on the people running the project and running the investment. And that is the lead sponsor team, the general partner, the operators, whatever you want to call them. It is the most important thing for you to do when doing underwriting is have the lead sponsor, the operator, the general partner, what is their track record and what is their experience in the specific asset class, in the specific location, and the specific type of business plan. Have they done this before? Have they done it before? That's the most important question. And if they have done it before, that's great. That gives you a lot of ease and comfort in security and understanding that the business plan could be executed and that they can have predictable outcomes. If they haven't done it before, that should be a red flag. If they haven't done it before, who are they leveraging and who are they partnering with? That can give you the sense of security in investing into that deal. Another way of saying it is, are they pitching you a pipe dream? A pipe dream. It's an imagination. It's a fantasy. They haven't done it before. They have no experience, and red flags should come up. If they haven't done it before, red flag. So, that being said, in summary, underwriting. Underwriting, you can underwrite the property, look at the location, the P&L, and look at the assumptions. And the most important of all, look at the general partner's track record. So that is a wrap for this 3-part series on what is a real estate syndication. I hope you understood now a little bit of what is a real estate syndication, how it operates, who are the players, the limited partners, the general partners, how they come together, they form an entity and invest in a property. Part 2, we talked about the reasons why you should be diversifying your funds right now out of the stock market and into commercial real estate. Syndications, fantastic passive opportunity where you don't do any work, leverage the expertise of the general partners out there. And once you have made the decision to do that, find the general partners that you like, that you trust, and then also do a little double checking on their track record and the property itself to make sure it is a good, safe investment for you. That's a wrap. Stay tuned, and we will see you next time for another episode of the Wealth Building Strategies podcast.